Have you ever wondered how financial managers make the right decisions for a business? How do they decide where to invest, how much risk to take, or how profits should be distributed? The answer lies in the principles of business finance. In this video, we'll learn about the 7 principles of business finance and the subject matter of business finance in a simple and easy to understand way. Let's get started. What are the principles of business finance? The principles of business finance are the basic guidelines that help financial managers make sound financial decisions. These principles help businesses increase profits, reduce risks, and achieve long-term success. Let's discuss each principle one by one. 1. Principle of risk and return adjustment. The first principle is the principle of risk and return adjustment. Every investment involves some level of risk. Generally, investments with higher expected returns also involve higher risks. Before making an investment, a financial manager carefully compares the expected return with the possible risks. The objective is to achieve the best possible return while keeping risk at an acceptable level. 2. Principle of the time value of money. The second principle is the time value of money. This principle states that money available today is worth more than the same amount of money received in the future because today's money can be invested and earn additional income. Therefore, before accepting an investment project, financial managers compare the present value of expected future cash flows with the initial investment. If the present value is greater than the investment cost, the project is considered worthwhile. 3. Principle of asset maximization. The third principle is the principle of asset maximization. The main objective of business finance is to increase the value of the organization's assets. Financial managers invest in projects that generate positive net cash flows and contribute to long-term growth. As the value of business assets increases, the overall value of the organization also increases. 4. Principle of liquidity and profitability. The fourth principle is the principle of liquidity and profitability. Liquidity and profitability often conflict with each other. If a business keeps too much cash, it remains highly liquid but earns lower profits. On the other hand, investing more money may increase profits, but reduce liquidity. The responsibility of the financial manager is to maintain a proper balance between liquidity and profitability. 5. Principle of matching or perfection. The fifth principle is the principle of matching, sometimes referred to in some textbooks as the principle of perfection. This principle states that the type of financing should match the type of asset being financed. For example, short-term funds should be used to finance current assets, such as inventory and working capital. Long-term funds, such as shares, bonds, and debentures, should be used to finance fixed assets, such as land, buildings, and machinery. Following this principle helps maintain financial stability. 6. Principle of business cycle. The sixth principle is the principle of business cycle. The economy does not remain the same all the time. There are periods of inflation, recession, economic recovery. Financial managers must consider the overall economic condition before making financial decisions. This helps businesses respond effectively to changing market conditions. 7. Principle of diversification. The seventh principle is the principle of diversification. A famous saying in finance is, "Don't put all your eggs in one basket." This means businesses should avoid investing all their money in a single project. Instead, they should spread their investments across different projects. If one investment performs poorly, the success of other investments can help reduce the overall loss. Diversification is one of the most effective ways to reduce investment risk. Conclusion on the principles. By following these principles, financial managers can make better decisions, increase profitability, reduce financial risks, and improve the long-term success of the business. Subject matter of business finance. Now let's discuss the subject matter of business finance. The subject matter of business finance refers to all activities related to raising funds, investing funds, distributing profits, protecting business capital. Let's discuss each area. 1. Use of capital or investment decision. The first subject matter is the use of capital, also known as the investment decision. Collecting money is not enough. The funds must be invested wisely to generate maximum returns. Financial managers decide how much money should be invested in A. Current assets, such as cash, inventory, raw materials, accounts receivable. B. Fixed assets, such as land, buildings, machinery, equipment. Proper investment decisions help maximize profits and improve business performance. 2. Sources of capital. The second subject matter is sources of capital. Businesses require funds to operate and grow. Financial managers identify the most suitable sources of finance. There are two main sources. A. Internal sources. Internal sources are funds generated from within the business. Examples include retained earnings, owner's capital, accumulated depreciation. These sources are also known as self-financing or owner's finance. B. External sources. When internal funds are insufficient, businesses collect money from outside sources. Examples include bank loans, creditors, financial institutions, money lenders, bonds and debentures. Choosing the right source of finance is an important responsibility of financial management. 3. Distribution of earnings or dividend decision. The third subject matter is the distribution of earnings, also called the dividend decision. After earning profits, financial managers decide how much profit should be distributed to shareholders as dividends, how much profit should be retained for future expansion, whether dividends should be paid regularly. A balanced dividend policy supports both shareholder satisfaction and future business growth. 4. Preservation of capital. The fourth subject matter is preservation of capital. Business assets and funds must be protected from unexpected losses. Possible risks include fire, flood, cyclones, theft, robbery, other natural disasters. Financial managers protect business funds through insurance, reserve funds, internal control systems, risk management policies. Protecting capital ensures the long-term survival and stability of the business. Final conclusion. Let's quickly summarize today's lesson. We learned the 7 principles of business finance. 1. Risk and return adjustment. 2. Time value of money. 3. Asset maximization. 4. Liquidity and profitability. 5. Matching principle. 6. Business cycle. 7. Diversification. We also discussed the subject matter of business finance, which includes investment decisions, sources of capital, dividend decisions, preservation of capital. In conclusion, business finance is much more than simply raising money. It involves making smart financial decisions, investing resources wisely, managing risks, distributing profits effectively, and protecting business assets. By applying these principles and performing these functions efficiently, businesses can achieve sustainable growth and long-term success. Thank you for watching. If you found this video helpful, don't forget to like, share, and subscribe for more finance and banking lessons. See you in the next video on Finance Guy.